Good morning, everybody, and welcome to the weekly analysis session for Monday, 25th of January 2016. Well, the first month of the year is just about past, and it's certainly been a very rocky road. We'll explore some of that as we go through today. As always, our disclaimer: the content of today's presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, your financial situation, nor particular needs. So please, before making an investing decision based on the general advice presented in any of the presentations, please consider whether the advice is appropriate in light of your financial circumstances. Okay, let's have a bit of a look at our agenda. Just a reminder for those of you who haven't caught up on the first session of the year, I did a webinar and had a look at 2015. So really reviewed the year. What did we learn from the markets over the course of the last 12 months? It was certainly a very interesting year, and I think certainly one that a lot of people would have learnt a lot. Not just about the markets, but certainly about themselves. So I think from that point of view, it's always good to have those sorts of markets. As I've always said, smooth seas never made a competent sailor, and it's during those times that it really is important that you stick to your trading plan, that you have faith in it, and its ability to protect your capital, particularly during extremes in volatility and wherever the market chooses to go. We never quite know. And so really it's that money management aspect of it that's central to all of that, but also staying the distance and maintaining a very even mindset wherever you can. So that recording, that webinar is in the portal. So those of you who haven't yet seen that, please go and have a bit of a look at that, because I think it'll provide a broad context for all of you and get you thinking about your ultimate outcome, which is obviously to make money over the longer term, but at the same time protecting all that valuable capital. Portfolio management, we'll go through that again today. There's certainly been a few changes since a couple of weeks ago with the last webinar that we had. So we'll go through and have a look at the benchmark indices, some specific setups, and some Q&A as well. So there we have it, extreme risk in both markets. I don't think it would take too much insight really to guess that were the levels that we were currently at. It's certainly been a while for the S&P 1500. It's managed to maintain sort of moderate risk or even moderate to low risk for quite a long period of time. And more recently, obviously, with that increase in volatility, the market really being pulled down and dragging our stochastic right down into the extreme risk territory. No surprise with the ASX 200, we've been underperforming for quite a while now. So from that point of view, I'll just turn my phone off as it's starting to ring, unfortunately. I'll just decline that. Sorry about that, folks. So that's where we are on both markets. So what does that mean for our asset allocation, if you like, or our capital allocation? Well, again, assuming that you have a maximum allowable drawdown of 15% across your portfolios, and you're splitting that capital, that allocation of capital between the two markets, it would mean that you would be allowed to have 7.5% of your capital is exposed as risk, if you like, in a low risk market. However, because we are now down in extreme market risk territory, we have to use our market risk multiplier. Remember, that market risk multiplier at the moment is at 10%, so 10% of that 7.5% means that you should have a VAR risk limit there of 0.75, not the 0.8 there. I think that's PowerPoint just rounding that particular number up. So that's what it should be for the ASX. Likewise there in the US, exactly the same scenario. Extreme risk, a 10% market risk multiplier. 10% of your 7.5% is actually 0.75%, and again PowerPoint just rounding up to the nearest whole decimal point. All right, so that's where we sit in terms of market risk at this point in time. Just a quick reminder, the macroeconomics session wasn't here obviously last week. I was having a brief family holiday in Bali. Education sessions, just a reminder that they will start again in the middle of February. and I've got a couple of commitments over the course of the next couple of Fridays. So we will eventually move to 2 new sessions, remembering a Friday afternoon session for the Australian market and a Monday afternoon session for the US market as well. But they will both start in mid-February, so we're not chopping and changing along the way. And again, if any of you need any assistance with anything, please feel free to request a coaching call. More than happy to spend as much time as you require. All right, let's go through and have a look at our benchmark indices for the first time for a couple of weeks. The XJO there, the ASX 200, you'll see that I've put on here a longer term moving average, and that's a 200 period moving average there, and just showing the, if you like, the price action in relation to that longer term moving average. Now remember, it's the price action that is actually dragging that moving average down. And I've just drawn on here a number of circles or ellipses, if you like, really just to show that that longer term moving average is now starting to act as a little bit like dynamic resistance in this particular scenario. So obviously, markets don't turn from bullish to bearish overnight. They go through a transition, and you can certainly see that over a period of time, particularly with the Australian market, since around about sort of April of last year, really starting to move below or down towards the moving average, and then eventually starting to close or spend a lot more of its time below the moving average, and now each time it's coming back up to it, starting to find resistance at those particular levels. By comparison, if we go through and have a look now at the S&P 1500 and beyond charts, just ticking over there now, similar sort of theme, perhaps a little bit behind the Australian market, in that you remember here through August and September, the big fall down where we found support at these sort of 435 levels on the S&P 1500 before moving back up to our longer term moving average. And now again, similar sorts of themes where we're starting to get points of supply gradually moving further and further down. Since the capitulation for most of this month, we've moved down. We've broken this previous support level, which is, I think, an interesting and a bit of a turning point, perhaps for the short term anyway, in that we've got this nice reversal happening at the moment. It's going to be key this week, really, I think, whether or not we can hold above this level or whether this old support level starts to act as resistance. If it does happen to hold, then I'd expect to see this market start to move back up towards its longer term moving average. Now, unfortunately, I can't put my little circle any further over to the right because beyond charts won't allow me to do that. But I'm expecting this market to, if it can hold at this level, to make it perhaps up somewhere towards that 460 level where we've once bounced off before. Likely to see that as a resistance area, and again starting to see this longer term moving average perhaps act as some form of dynamic resistance as we go through. In terms of new setups, let's go through and have a look. There weren't too many. Interestingly, though, I did happen to find a couple in the Australian market, and the ones that I've got in here are CSL, but it hasn't come up. I did my analysis on it the other day, and it's unfortunately beyond charts hasn't saved my analysis. So what we might do is go through and do it right now. So the first thing about this particular setup, and let's go through and put on our ETC overlay. Good practice as we go through and do this as well. So obviously in terms of relative strength, that's one of the reasons why the stocks come up on the particular scan. In terms of price action, again remembering where is that last trough in relation to the second from last medium term peak. Well, there's the last medium term peak. There's our second last. It's well clear of that. The only other thing to do in terms of this stock is to zoom out and see where we are. Now, certainly we're at all-time highs, and CSL obviously is a beneficiary of any weakness in the Australian dollar. To structure this particular trade, pretty simple sort of task. Obviously, our last candle has already passed, if you like, or breached the last medium-term peak. So if we want to enter on this particular setup, then all we need to do is place an on-stop order 0.5% above the high of that last candle there. So the high there, 108.27. So if I go down and grab my little calendar, 108.27 and multiply by 1.005. That's 0.5% above that level, so we have an entry at 108.81. So I'll just annotate that, pop that on there. On stop at 108.81. Now the next element of it is our stop loss, not SKL, stop loss, David. So let's go through and put on our horizontal line to start with. So that's got to be at 108.81. So there we go, 108.81, and I'll just change that to blue. Most of you will be pretty adept at this by now. So in terms of our protective stop, remember our protective stop needs to be at least 2 ATRs away from our entry level. So I need to put on the value line, find out what 2 ATRs is, and 2 ATRs is $8.15. So if I go back to my calculator, that's our entry level, and subtract $8.15, 8.15, we get a protective stop at 100.661. So I'm just going to put that into memory at the moment. And let's just go through and make sure that we're at least 0.5% below that last medium-term trough. So what I might do here with my annotation so I don't lose it all is I'll put that stop loss in there at 100.66. So 100.66. And then what we'll do is we'll just go through and do some quick sums. The low there, 101.41, so we need to make sure that we're at least 0.5% below that level. So that particular level there, 101.41 times or multiplied by 0.995 equals 100.90. So certainly that's 0.5% below, but we're also remembering that we need to be at least 2 ATRs away, so we need to defer to the number that's further away, and in this case it's 100.66. So let's go through and put in our protective stop line in there at 100.66, and I'll just make that red. There we go. Annotation complete. I'll just get rid of that value line. There we go, and I'll save that. So I'll create a new analysis. And whilst Beyond Charts thinks about creating that new analysis for us, I think the only other one that I managed to find in the ASX was Domino's Pizza. So we'll go through and have a bit of a look at that one as well. A couple of other stocks that are performing pretty well over the last week. As Beyond Charts, there we go. Did it save? New analysis. There we go. I'm going to get that one there. I'm going to clear the default on that one. And that new analysis that I've just done, I'm going to set that as the default. So every time I go in and type in CSL, it's going to bring up all my annotations and all my analyses as I've just drawn. So CSL, that's the first one, on stop at 108.81, and a protective stop coming in at $100.66. The other one on the list, and hopefully it's brought it up and it's saved my annotations. Now you'll see a few lines on here, and the reason for that is that this previous setup down here, you'll see, we had an on-stop order a couple of months ago now at 49.15. with a limit to 49.38 and pretty stop down at 43.35. Well, that's obviously triggered, and with that nice strong price action as well, that original entry level has also managed to drag up that protective stop pretty much to break even now. That's the 3 ATR trailing stop. In terms of price action, this last candle has now helped to form a short-term uptrend, so that's what we're looking for. Good price action. Where is that last trough in relation to the second from last medium-term peak? Well, you can see it's well clear. Our relative strength is extremely good. It's been very, very strong for a long period of time. We just need to zoom out and see whereabouts we are. So zooming out all the way, its entire history, certainly been a terrifically performing stock. So let's just go through and have a look at the order for this. So 0.5% above our last medium-term peak. So that sees an on-stop order at $60.88. Now, stop loss needs to be at least 0.5% below that last medium-term trough and outside of 2 ATRs, and that has our stop loss coming in at $54.32. I think they were the main ones in our list there from this week. Pilbara Minerals is certainly another opportunity. The only element about this one that you need to be thinking about is on this particular one, there are a few black candles in here along the way, so it's not as perhaps nice in terms of overall candles or dominance of white candles in this. Having said that, though, in terms of price action, it still meets the criteria because our last trough is at or above the second from last medium-term peak. So what we need to do with this particular one is think about, well, where has this been before? Again, zooming out. Now, what you'll see along the way here is that we do have, over on this side over here, a medium-term uptrend, and on this side we've obviously got medium-term downtrend. So this little peak over here is basically what we now call a long-term peak. We're really at that level. We've already had that first test of that particular level. Price has retraced. It's starting to move back up again. So other than that, the only other high point prior to that is all the way up here, getting close to 90 odd cents. So certainly if we do happen to break this particular level, in terms of risk to reward to that old level, we can get 2 to 1 in there. The only, I guess, thing to be thinking about is if we happen to get into this particular trade on stop at just over 40 odd cents, and we've got a protective stop down at 21 cents, we've actually got quite a significant, in terms of percentage at least, a fairly wide stop. Now, traditionally what we've looked at is trying to keep our protective stop somewhere around about 10%. You know, it really doesn't matter all that much as long as you adjust your position size accordingly. So again, remembering that, you know, if you're risking 1% or 0.5% or whatever it is, that you stick to that and make sure that you don't mark up your position sizing and have more risk than what you need. And just on that particular topic, given that we are currently in extreme risk and you're seeing new trades come along, and you might be in a position where you're able to take a few trades or whatever it is. I mean, obviously everybody's going to have different allocations because they've either been in the market for a while or they might be just starting out. Certainly being in extreme risk market at this point in time, there's no necessity to have the full normal amount of risk on each of your new trades. So if you were risking, as an example, 1% on any normal trade, you know, given that we're in extreme risk at this point in time, certainly see nothing the matter with halving that as an example, and perhaps just starting off with 0.5% risk on a trade. And should it trigger and you get to the position where you want to add into it later on, then certainly you can always add to a winning position. So that's just something for you to think about as well. Over in the US, let's go and see if he's got any pendings over there. There was only the one in the US that I managed to find, and that was on WTR. And again, we're at We're at all-time highs on this particular stock. So obviously in terms of relative strength, given what the broader market's been doing, holding up pretty well. So all we need to do, think about our price action. Again, last trough, well clear of the second from last medium-term peak. Interesting that this old long-term peak, now that, which was obviously a fairly significant point of supply, now that that's been breached, price coming back to retest that, that's also a very positive sign as well, and obviously relative strength ticking the boxes as well. So we just need to break our last long-term peak, and to do that we just need to place an on-stop order there. It's a little bit small, but hopefully you can see it. On-stop order at 31.24 and a protective stop. Remembering it needs to be at least 0.5% below our last medium-term trough, and at least at a minimum of 2 ATRs from the entry. So that's a stop loss there at 28.20. Very good. Okay, so a little bit of let's have a look. Ken says I had EML in my shortlist. So EML, Ken, was that of a short list of long trades, or is that on a list to be looking to go short? EML in the ASX. Okay, thanks, Ken. I'll go and have a look at that, because I reckon that may well have come up as well. So let's go through and have a look. Thanks for that, Ken. And BURRY. Berry is long on water in the US. Not too sure what that means, Ken, but we'll certainly, let's go back to the Australian one, and I will bring up EML, because I seem to remember that, and I'm not too sure. Let's go through and have a look. There we go. So you can see here that I've done an annotation on this, and at this point in time, some of the reasons why you might consider this particular trade. Well, certainly, obviously, the relative strength aspect of it is fine. In terms of the price action, last trough at or above second from last medium-term peak, absolutely. So we've got ticking the boxes there. You'll also note that I've also got a little green line up above there. Now, the reason I've got that is that there is a long-term peak back here in 2010. Now, it's really, really close, this particular setup. Very close to getting 2 to 1. And look, I really wouldn't have, I don't have a problem, looking at this particular trade. It's not quite 2 to 1, but it's very, very close. It's a couple of cents shy of 2 to 1. So other than that, certainly it meets all the criteria. So Ken, that's I'm pleased that you've picked that up. As I said, I've just got in my annotation there, not quite 2 to 1. So again, from the previous webinar, you might remember that it really is important to try and find setups where you've got a minimum of that 2 to 1 as your initial goal, and this is pretty close. So in the broad range of things, given that we've broken out past the previous long-term peak, and again that's now starting to act as a nice point of demand. So if you like the change of polarity, if you like, where point of supply now starting to act as point of demand. Not a bad candle last week as well. So well picked up there, Ken. Okay, so let's also go through, I think, the US. What we might do, we had a look at the US pendings there. That was the only one. WTR, again, just on stop 31.24. Protective stop at 28.20. Now, what I'd like to do here is just go through the ASX market just very briefly. There were a couple of stop outs over the last couple of weeks, so I just want to draw your attention to those. One of those was on MVP. Medical developments. So let's just go and have a look at that one. And again, you'll see through here that once the stock was triggered, moved up quite strongly, and at the same time dragged its trailing 3 ATR up. 2 weeks ago when I was here, it did close above that trailing 3 ATR. Last week, closing below it. So that means a market exit on the Monday morning. So from that point of view, you would have exited at the open at around 295. So that was MVP. So that will come out of the watch list. The other one was SYD, Sydney Airport. And certainly the last couple of occasions where Sydney Airport's been in the watch list, it's moved quite nicely and then come back and close below its trailing 3 ATR. You might remember that more recently, a slight change to the way that we were handling the initial protective stops. So once we get same principle as when we're using a trailing stop. Once price closes below our initial 2 ATR base stop, we need to exit at market. Now, the previous week, price closed at $5.97. Our protective stop was at $6.03. So that would mean that we exit at market the following week, and wouldn't you know it, great big white candle shooting back up the opposite direction. So if you happen to exit following your rules, you would have exited there at the open, and the open there at $5.92. If you happen to stay in, well, then you were the benefit of a big white candle, but not following your trading rules. The problem with that, not exiting and leaving it one more week and getting that big white candle, is that you are becoming a victim of what's called recency bias, and that means effectively that last candle is having if you like, an impact on the way that you perceive the importance of following your rules. And next time you get a candle where you should exit, you'll say to yourself, well, last time I didn't exit and I got this big white candle, so it's okay for me not to follow my rules. And Murphy's Law is that the next time you do that, it won't be a big white candle that way, it'll be a big black candle the opposite way. So you just need to be thinking about that, and one trade doesn't make a career. Other aspects in the ASX this week, a couple of trailed stops. CKF, Collins Food, just moving up nicely there. You'll also see that we've got another price volume volatility signal. So those of you who are still in that, well done. You should be in it. If you got into it back through here, absolutely no reason not to be getting into it. We had price volume volatility signals up here, and certainly once price had moved beyond those levels there, certainly a very positive sign. Another price volume volatility signal. So if you haven't taken some profit off the table at this point, then there's the opportunity to consider taking half off at that particular level. CKF going along really nicely. Another one, DMP. Now I'm pretty sure that I had this. There we go. It's already in, so this is another setup subsequent to the earlier one, and you'll see that last candle there, which is the one that created the short-term uptrend and therefore has structured this new setup for us, has also lifted that trailing at 3 ATR from the initial setup as well. In the US, a couple of stop outs that I'd like to go through now. CTAS is a stock that was stopped out over the last couple of weeks. So we'll just go through there and have a look at that one. So the trailing stop there, 83.51. The close there, 84.03. But last week, on that last candle there, the close 82.44, which is obviously below our 83.51. So that's a market exit at the next market open. So that's on CTAS, ISBC, Investors Bancorp. Again, just going through these so you can see how these have performed over the last couple of weeks. Previously, it closed at 11.55, and our trailing 3 ATR was at 11.53. So that's above that, but last week, or the previous week I think it was, certainly got a close below that particular level there, 1140, well below the 1153. So market exit on that one from the previous week, and hopefully you're getting the hang of all of that as well, so that you're comfortable making those particular decisions and taking the appropriate actions along the way. VMC, not last week, the week before, again, closing below its trailing 3 ATR, so that's a market exit on the following week. That was VMC. POST, Post Holdings. Again, this is a stock that triggered in at this particular level. Now, this was a lot earlier in the year, and in the watch list at the time, you might remember the old rule that we had, which said once our initial 2 ATR based stop is breached, then we convert to a hard stop. That was the old rule, and so we had to wait until price came down and challenged that particular level. So from that point of view, we ended up giving back a little bit more than what we perhaps initially were willing to risk on the trade. That was POST. IDTI was the third last one. I'll go through and have a look at that. And this particular candle here, this big black one, price closing below our initial 2 ATR based stop. So market exit the following week, and again, a little bit of market strength last week, and again, just coming back above that level. But our rules say price closed below our initial 2 ATR based stop, so we need to exit at market. SNA was the second last one. And again, our last entry level through this particular level at 172.75, price coming back, closing below our initial 2 ATR based stop, and on that particular one, the open open at 158, so exiting at the open and closing at 153.10. So again, one of those examples there that if you don't follow your rules, that you may well end up experiencing a bigger loss than you needn't have. All right, in terms of trail stops, let's have a look. The good with the bad. Coresight Reality. Again, just last week, nice candle, just bouncing, starting to move up there. Well, not actually trailing on this particular example, because our 3 ATR line hasn't yet surpassed our initial protective stop, but starting to move up in that particular direction. So that was CORELANC, Lancaster, the top one there. That one dragging that 3 ATR up in the right direction as well, so that's always a good sign. And I think the last one was McDonald's. And I'm not too sure why I had that in there. Maybe I think I've just looked at that last little bit of the trailing 3 ATR. Certainly it's dragged that up just a fraction, but again, it's not past that initial 2 ATR. So no need to trail on that one just yet. Hopefully we get a little bit stronger, a little bit more strength in this particular market, then I can certainly see that 3 ATR base stop moving up above our initial 2 ATR. All right, folks, that's about covers it from my end. Any questions? It's been a couple of weeks since last we spoke, we engaged. Hopefully the market's not treating you too abruptly. Keep our fingers crossed for a bit of a bounce in the market over the next few weeks. Certainly, it's very much a matter of paying attention to what the market risk is at this particular point in time. Certainly, the fact that we've closed below those longer-term moving averages on both indices is significant. What I will say about this particular market, we really need to wait and see what's going to happen and whether this market's got legs in it enough to get back up to these previous levels and hold, or whether it just manages to go back up and turn around and fall back down. We'll just have to wait and see. Obviously, we don't have a crystal ball. Certainly, these zones of supply working their way towards the downside. We're in extreme risk at this point in time. Certainly, I think it's well worth just being very cautious. ELS, Kim's brought up, so let's go and have a look at ELS. ELS, this was one that came up on the scans. I'll just bring that one up. And there we go. ELS, and you'll see that I did actually have some basic annotations drawn on it, and the reason why this one didn't go in, and it's just so close, and Kim, you've articulated, or not articulated, you've annotated, you've written, expressed your words exactly to the letter of the law. This is a great setup. The only thing that it doesn't have, and it's really splitting hairs on this one, look at the relative strength. It's been certainly performing very, very strongly, outperforming the market for a long period of time. Price action's really, really strong. Last trough, is it at or above second from last medium-term peak? Well, if we go through, and it's a really good example, the low there is 63.62, and the high there is 63.67. So is 63.62 above 63.67? No, it's not. But look, there's not a lot in it. In terms of price action, everything's really pretty good, isn't it? When you think about it, we've got rising troughs in a market like we've got at this point in time, certainly coming through with very, very good relative strength. It has no overhead resistance, so from that point of view, it really could go anywhere. What it did do recently, obviously, had a bit of a period of sort of sideways movement, if you like. But now that it's moved out of that particular sideways movement, you'll see that the troughs that it's putting in are all at subsequent higher levels. So really, good points of demand all the way through. So that was the only reason that ELS didn't make the watch list. But again, it looks very, very strong when you compare it with the rest of the market and what it's doing. So good pick up, Kim, and thanks for bringing that one for everyone to see. So hopefully that clears that one up. Any others? No, I'm not jet lagged. I do have a bit of an earache, so I think too much swimming in the pool and listening to headphones or little earbuds in my ear, and then getting on a plane, so my ears are ringing. But that's all right. I'm sure that'll go away over the course of the next day or two. All right, folks. Well, if that's it, then I will catch up with you a little bit later on in the week for the macro session with Jeff, and also on Monday morning for next week's analysis session. So hopefully the market treats you well, and I look forward to catching up with you next week. Bye for now.